The 2008 financial crisis. A house of cards in September 2008, Lehman Brothers, a bank older than the Civil War, vanished overnight. $600 billion evaporated. Retirement accounts were wiped clean. Millions lost their jobs. But what if I told you that it all started with a simple lie? A lie so convincing it could fit on a billboard. Why rent when you can own? It's 2002. America is still reeling from the dot-com crash and the trauma of 9/11. The Federal Reserve has a plan: slash interest rates to near zero. Money becomes cheap, borrowing easy. Suddenly, buying a house isn't just about having a place to live, it's the American dream. Banks start throwing money at people like it's confetti. Adjustable rate mortgages, balloon payments, and ninja loans. No income, no job, no assets become commonplace. Homeownership was more than just a roof and four walls. It was stability, status, suburban bliss. The message from every ad, billboard, and mortgage seminar was clear: why rent when you can own? Banks agreed wholeheartedly. They started lending to anyone with a pulse, subprime mortgages for those with bad credit, unstable income, or no assets at all. If you couldn't afford the payments, it didn't matter, just sell the house for more. By 2005, buying a house wasn't about living in it anymore. It was about flipping it like a stock. Real estate became a lottery ticket. People bought houses they never intended to live in, hoping the next buyer would pay double. Even McDonald's employees and baristas were getting approved for mortgages. The housing market was on fire, but beneath the surface, rot set in. The subprime mortgages were toxic, high-risk, barely verified debt. But Wall Street had a solution. Bundle these bad loans together, slap an AAA rating on them, and sell them as safe investments. Mortgage-backed securities, MBS, and collateralized debt obligations, CDO, turned garbage into gold. The ratings agencies, paid by the banks they were supposed to evaluate, called toxic assets safe. It was like hiring a food critic who only gets paid if they say your raw chicken is Michelin-starred. A few skeptics saw through the lies. They wanted to bet against the housing market but found no product for it. Wall Street, smelling easy money, created credit default swaps, insurance contracts that paid out if these investments went bad. You didn't even need to own the investment to buy the insurance. It was like buying life insurance on your neighbor's grandma and hoping she falls down the stairs. The system became a Jenga tower of lies and leverage. Every block was a bad mortgage, every layer a bigger risk. At the top, bankers celebrated record bonuses. Whistleblowers were ignored, regulators dozed off, and those in charge were too rich to care. The party raged on while cracks spread beneath. In 2007, the first whispers of trouble began. Missed mortgages, foreclosures, empty condos, but then came the wave. Home prices started falling, something that was supposed to be impossible. Subprime loans imploded, and with them, the MBS and CDOs. Banks holding these safe assets realized they were sitting on financial plutonium. Panic spread like wildfire. Hedge funds bled, investment banks collapsed, and Lehman Brothers, a 158-year-old institution, vanished overnight. The credit markets froze. Loans dried up, payrolls couldn't be met, and investors couldn't cash out. Retirees watched their savings vanish in real time. By late 2008, the collapse was full-fledged. Millions were unemployed, foreclosures skyrocketed, and soup kitchens struggled to keep up. Unemployment offices looked like disaster relief camps. The crisis didn't stop at U.S. borders, it spread globally. Markets crashed, banks buckled, and economies spiraled. The U.S. government faced an impossible choice: let everything burn or throw billions of taxpayer dollars at the problem. They chose the latter. TARP, Troubled Asset Relief Program, was born, a $700 billion bailout to prop up failing banks. AIG, the insurance giant that bet trillions on garbage, received over $180 billion. Even GM and Chrysler got aid. The Fed slashed interest rates to near zero and started quantitative easing, printing money out of thin air to buy bonds and mortgage junk. It worked, but Main Street suffered. Unemployment hit 10%, 8 million jobs were lost, and $19 trillion in household wealth vanished. Families who had never missed a payment suddenly owed more than their homes were worth. The aftermath was bitter. Wall Street bonuses returned while Main Street stood in line for soup. The Occupy Wall Street movement erupted in 2011, fueled by anger at a system that protected the powerful and punished the rest. No major Wall Street CEO went to jail, they got golden parachutes instead. The crisis taught us a harsh lesson: the next one won't look like this. It will seem harmless, profitable, inevitable until it isn't. And when it hits, we'll be wondering if we learned anything at all. And so, as the dust settled and the economy slowly began to mend, a quiet but insidious lesson was etched into the fabric of society. That the system is built on a foundation of trust and transparency, but when those principles are compromised, the consequences can be catastrophic. The scars left by the 2008 financial crisis were deep and wide, cutting across generations and continents. But in the shadows of this recovery, new players emerged, eager to capitalize on the lessons not learned. Cryptocurrencies, fintech startups, and shadow banking systems began to flourish, promising a future free from the shackles of traditional finance. They whispered of decentralization, transparency, and empowerment, words that echoed the same promises made by those who sold the dream of homeownership in the early 2000s. And as these new financial instruments gained traction, the same patterns began to re-emerge. Leverage increased, risks were obscured, and once again, the warnings of a few were drowned out by the collective optimism of the many. The next crisis was being sown, not in the boardrooms of Wall Street, but in the digital ledgers of blockchain and the algorithms of high-frequency trading. In 2035, it happened. A series of rapid, interconnected failures in the crypto markets triggered a global financial collapse that was even more severe than the one before. This